I'm Doris. I'm here to share with you about my stock account, and today I'm going to be updating with you about the market. The global economy has entered an era of chaos. Recently, the global economic recovery shows a lack of dynamic weakness, with major economies yet to return to potential growth levels, and economies growing slower than expected. Secondly, there is a contradiction between recovery of supply and demand. The imbalance between supply and demand makes the recovery process more difficult, and the normal operation of the economy is distorted. Moreover, the global recovery pattern has begun to divide, and the situation of fewer strong and more weak has been strengthened. The U.S., with a developed service industry and advanced scientific and technological innovation capabilities. Finally, the process of recovery has begun to occur. Frequent trade frictions between the countries occur. Geopolitical contradictions are deepening, and the confrontation between two different countries is intensifying, which has not only hindered the tide of globalization, but also impacted the global economic recovery. At the present, the global economy is in a downward cycle. Negative factors such as high inflation, tight monetary policy, and financial market instability have dragged down the recovery of global economic growth, and the recovery is highly inadequate. First, the recovery in the major developed economy has slowed. In the first quarter of 2023, U.S. GDP fell at an annualized rate of 1.3%, below potential growth, and was down sharply from 2.6% in the previous quarter, indicating a slowdown in economic activity growth. Among them, U.S. corporate profits fell 5.1% in the first quarter, with the third consecutive quarter of decrease. The Association of Supply Management Manufacturing PMI has been in contracting territory since November 2022, and the services PMI is still expanding and in its expanding territory but declining. Similarly, the first quarter, European Union GDP grew 1% year-on-year, down from 1.7% lower than the previous value and 0.1% from the previous quarter. Germany, the largest economy, fell 0.2% year-on-year and 0.3% from the previous quarter. Secondly, falling demand in major economies brought to emerging markets and developing countries. For example, from January to May in 2023, Vietnam's export fell by 11.6% year-on-year. In May, China's manufacturing and non-manufacturing new export orders PMI fell into the contraction range, and the total imports and exports also declined year-on-year. According to WTO forecast, global commodity trade volume is expected to grow by 1.7% in 2023, lower than last year's growth. The global GDP growth in 2023 is expected to be 2.4%, both lower than the average level from 2010 to 2022. Moreover, although it's on track for recovery, the slope for recovery seems to be less than expected. And the growth center of trade, investment and consumption has declined, dragging down economic growth lower than potential growth levels. The IMF has repeatedly lowered its global economic growth forecast for 2023 from 3.6% in April 2022, reporting to 2.8% in its April 2023 report. The European Union expects its 27 member states to grow by 1% in 2023, below the July 2022 forecast of 1.5%, and below the European Union's potential economic growth rate. At the end of the first quarter of 2023, the Federal Reserve cut its U.S. GDP growth forecast for 2023 to 0.4%. It is expected that by the end of this year, the credit of the U.S. household sector will fall significantly with the near bottoming of excess savings. The overall credit will continue to shrink and weaken the stability of the U.S. financial market, and eventually affect the real economy sector and bring the economic activity into a recession cycle. Supply inflation and demand deflation coexist, and the complexity and antagonism hinders the process of global economic recovery. In the economic recovery period after the COVID-19, supply-side inflation and demand-side deflation appeared simultaneously, reflecting the different challenges and adjustments process between the supply and demand after the new supply shock caused by the epidemic subsided. The emergence of supply-side inflation can be attributed to two reasons. First, it takes time for supply chain bottlenecks to repair. During the pandemic, global supply chains have been severely disrupted, and the production disruptions, traffic restrictions, and border controls have led to shortages of raw materials and goods, and the geopolitical conflicts have pushed up commodity prices. Secondly, the rising production costs are sticky. During the epidemic period, the enterprises have faced difficulties in manpower, material resources, and capital. At the same time, demand-side deflation is also occurring in the recovery period, mainly due to the lack of consumer confidence. During the pandemic, consumers have faced problems such as unstable employment, declining income, and economic uncertainty, which have severely hit consumer confidence. Consumers' willingness to consume weakens, leading to a declining overall demand. At the same time, due to an increased uncertainty, some consumers and enterprises tend to save more to cope with the uncertain future, which suppresses the overall consumption and investment demand. Moreover, transformation of consumption patterns and the reconstruction of consumer confidence cannot be achieved overnight, and the high inflation level has further weakened the purchasing power of residents. In addition, the state of monetary tightening has worsened the fiscal pressure in emerging market countries and weakened the impetus of government spending and investment, leading to a decrease in public demand and downward pressure on the overall economic demand. A differentiated resuscitation structure. In the weak and complex recovery path, the structural differentiation is inevitable, and the pattern of less strong and more weak is constantly strengthened. In terms of specific industries, the services consumption recovery is significant, while the manufacturing sector contraction. In the U.S., for example, consumer spending and services were strong. Despite the overall economic growth, data on personal income, personal spending, and consumer spending were relatively positive. Personal income increased by 0.4% in April 2023, while personal spending and consumer spending increased by 0.8% respectively. The service sector showed a strong expansion. In May 2023, the ISM non-manufacturing PMI was 50.3%, while the manufacturing PMI was 46.9. New orders, inventories, output, and supplier delivery were in the contraction range. For the perspective of the upper, middle, and the downstream industries, corresponding to the strong recovery of the service industry, the downstream industry recovered strongly, while the manufacturing industry is weak. For the perspective of the government and the market, economic research shows that most of the world's countries during the pandemic implemented a combination of various policy tools, including fiscal stimulus, monetary policy, foreign exchange intervention, macroprudential regulation, adjustment, and capital controls. On average, these countries used 4 or more categories from 6 category tools to stimulate their economy. And the stimulus, almost all countries announced a large-scale fiscal stimulus, on average of about 11% of GDP. There is no denying that the stimulus effect of macro control in economic recovery, but the stimulus policy cannot be expanded without limit, and the expansionary fiscal stimulus and tightening monetary policy are reversed under the state of stagflation, which is bound to worsen the state of economic recovery. More importantly, the confidence of the market has changed. When the scar effect of the pandemic began to appear, the uncertainty brought the pandemic still stays in the heart of enterprises and residents, and the weak recovery momentum has further dragged down the recovery of the confidence of enterprises and residents. In May 2023, the U.S. Consumer Confidence Index fell to a low in 6 months from 64.9 in January, down nearly 30 units from its April 2021 high of 88.3. According to the latest Business and Consumer Survey data in May 2023, both the European Union Economic Climate Index and the Employment Expectations Index also fell, with the ESI down 1.9 points due 95.2, and the EEI down to 2.2 points to 104.0. As we said before, the pandemic is a supply shock, and the macro policy regulation on the demand side cannot be fundamentally solve the problem. Indeed, earlier stimulus policy have helped the country's economy to recover, but this has only eased the pain and bought the time for an endogenous recovery. Recently, the AI chip supplier NVIDIA has risen more than 160% this year, as the ChatGPT briefly topped $1 trillion on May 30th. In an environment of weak risk appetite and volatile volatility, the market is not the lack of liquidity, but looking for deterministic, high-quality assets, as the market is aware that the total manufacturing productivity driven by technology is the only definite growth direction. Large amounts of money have poured into the technology sector, exacerbating the imbalance between different sectors. The Nasdaq, led by technology stocks, is up 26.28%, while the S&P 500 is up 11.84%, and the Dow Jones Industrial Average is about 2.07%. In the context of such differentiated recovery, the U.S., the world's largest economy, has further highlighted its advantages such as its high proportion of services, strong spillover of macro policies, and sufficient scientific and technological innovations capacity, which has consolidated the resilience of its economic growth. In contrast, the recovery of other countries is still bumpy. Europe faces problems such as lingering conflict between Russia and Ukraine and high inflation, and the recovery process of fission. The trade frictions and geopolitical contradiction among countries are deepening. On the one hand, trade protectionism has hit the tides of globalization, which not only hinders the global recoveries of the global economy, but also brings great challenges to international cooperation and multilateralism. On the other side, geopolitical fission will impact the global governance model. The camp and the pendiology of international relations will intensify the deglobalization among major countries in the fields of science and technology, information trade, and other fields, which is mainly manifested in the following aspects. First, the field of science and technological information will change from open cooperation to defensive sections. Second, the energy supply mode changes from long-term dependence to long-term independence. Third, the global trade value changes from international division of labor and to regional cooperation. Fourth, the financial capital changes from rapid expansion to diversified hedging. Fifth, the global combat readiness awareness is strengthened and the regional opposition expands. These 5 changes will accelerate technological sanctions among different countries. While different countries and regions will pay greater attention to data security, transformation of energy supply mode, and the development of regional global division of labor will reshape the global energy supply chain and the trade value chain. Moreover, the state of high volatility in the global financial market in the fission process will continue, or further weaken the global financial stability, and the growing demand for security will eventually lead to the comprehensive collapse of the global governance mechanism. However, the upgrade of confrontation between countries for the global economic recovery in the short term related to industries' negative impact and can impact the global financial market, lower return on assets. That's all I have for today. Thank you for listening. Don't forget to subscribe. See you next episode.